You're listening to Seattle Real Estate Podcast.
Hey everybody, I'm Sean Reynolds, the owner of Summit Properties Northwest, Reynolds & Kline Appraisal, and your host of this episode of the Seattle Real Estate Podcast. At the beginning of the coronavirus outbreak, and right about when all of our economies were shutting down, everybody was told, hey, you got to go work at home. I did a podcast on, and it was right before that. I'm going to say, that was like beginning of March. I'm going to say it was like end of February. I did a podcast of, here's the 4 things that could probably blow up a real estate market. And they were like, if the interest rates went to 7%, if there was a major meltdown in the financial markets, this weird virus called COVID-19 that was in China that we didn't know about, if that really ever ended up doing anything, that was one of those things. And I remember some of the feedback was, I don't think this is going to age well because the coronavirus is getting really bad. So everybody in real estate, we kind of just went into this panic mode of, oh my gosh, what is going to happen? I had brokers, I had conversations with longtime brokers that I've known for years and years and years that do a ton of business. And they were like, oh my gosh, are we going to have a short sale market here? Are we going to have a foreclosure market? Do I need to go back and work on my specializing degree in foreclosures, whatever that is? But are we going to have to go to a market that's wildly different than we're dealing with right now? Which, well, in February, we had a real estate market that was just rolling along. We were just like nicely set up for a great spring. Things were normal. Interest rates were good. They weren't as good as they are right now, but they were still really good. And we were just going to have a great real estate year. And so when the coronavirus happened and everybody had to stay at home, and for like 2 days in Seattle, real estate brokers were not deemed essential. And then the governor said, yep, you guys are good. Here's how you got to do it. In this really ratcheted down environment, we're able to do real estate, but we're able to keep going. Commercial guys, not so much. They had to just kind of work from home and they couldn't really do anything legally anyway. I think people just kind of rolled through it and did their own thing. I think a lot of businesses did that, right? I mean, you can't literally shut that much of the economy down. Some of the businesses you almost have to, like massage therapy, just one person on basically, super close confines with another. That's just not going to happen in the era of the Rona, right? So the article I came up with today was why the housing market is one of the hottest trends in a pandemic. And that's what my office manager, Irma, and I talk about all the time. And it goes along the lines of, in what world do you have a red hot real estate market when you're in the middle of a global pandemic? How does that work? And that's always kind of been in the back of my mind, is this is the weirdest thing. You've got a market that is just going bonkers in the right way. You've got record low inventory, you've got record low interest rates, and you've got a market that is just scorching hot, not just here in Seattle, but across the United States. Article after article after article on other areas of the country that just basically state real estate market is cruising along. And it has to do with big demand and low supply and low interest rates. That's just where we're at. So yeah, housing market being a hot trend in a pandemic. Let's look into that. Let's take a look a little bit further and see what we've got. As Americans settled into, and this is an article from Forbes, and it is an editor's pick by Megan Gorman. Sorry, Megan. She's a senior contributor. As Americans settled into the summer of COVID-19 pandemic, an interesting phenomenon was occurring across the country. People have been moving. In fact, the National Association of Realtors found in their recent June report that existing home sales jumped 20.7% from May of 2020. So May to June, you've got a jump of 20.7%. That's an enormous number on a national level. Some of that, I think, is attributed to the fact that so many people couldn't do anything in March, April, and some of May. And then by June, when kind of the lockdown started to end, all right, let's take this opportunity. We don't know when the second round of the Rona is going to come back through. Let's jump on this. We were going to do a move anyway. We were going to sell our house anyway. But you've got just a ton of rotation in the real estate market. So upswing of 20.7% of existing home sales between May and June of this year. That's an enormous number. And like I said, some of that is because we had such small numbers through March, April, and May. And then to compare that to when things took off, it's like, wow, there's this big disparity. But the fact is that it is happening during a global pandemic. And that's a weird phenomena. We've had the real estate market get shut down from so many smaller events in the past that, I mean, when you see a global pandemic coming and you're a real estate dude, you kind of think, is this the one that puts me out of business? Do we finally go out of business on this one? And yet here we are a few months later and things are just, they're going. I mean, there's not enough homes out there for all the buyers. And everybody's trying to jump in on these low interest rates. That's just what's happening all day long. In many ways, the time spent inside people's homes during the strict lockdowns across the country probably caused many Americans to rethink how they live. Further, with the likelihood that there may be another stricter lockdown in the fall, many want to get their housing situations worked out during the hot summer months. That's what's weird about this summer has been, I mean, we are August now, we're in late August. Next week is September, which I can't believe, but as I get older, I keep saying more and more ridiculous stuff like, where did that year go? What happened? Why didn't I go out more? Well, this year it's because of the Rona, but in August, normally, August is a real estate market. It's a breather from the hot spring market is usually what happens. So in real estate, you've got these real cycles of when things get busy and then when they slow down. Winter is usually everybody hibernates. Everybody's made their killing or not, however you look at it. The younger brokers still keep going, but the older brokers are more established who know they've got business coming through their pipeline. They tend to take off the holidays and swing back around second week of January, whatever, come back from their vacations in France or whatever it is that they do. Go to Maui. Maui's a solid option. I wish I could go to Maui right now. Even in August, I'd go there. But the Hawaiian Islands, they're on another lockdown. Oahu's on another lockdown. That's just not going to be good over there. I don't know how many of the little places I love to go to on Maui are just going to be shut down. I'll go there and it's like, oh, this isn't open ever again. This is not good. I mean, it's just going to be devastating. But, you know, different areas of the country have dealt with the Rona in a different way, and Hawaiian Islands, they have a tough go. Another group of Americans see a unique opportunity in the housing market. Rather than acquiring a new personal residence, they're looking to buy property to rent out. Yeah, I think they are, but for the most part, it's owner-occupied purchases that are happening. You've got owner-occupied purchases and you've got refinances just dominating the marketplace, and that's because of interest rates. That's all there is to it. But buying and selling a house is one of the biggest financial transactions you can undertake in good times. With a pandemic raging, it requires that you take a careful look at the environment around you to ensure that whether buying a new home or investing in rental property, you make sound decisions. Now, Summit currently have, I'm not going to give away too many details, but we've got a studio. Is it a studio or one bedroom? I think it's a studio condo in Belltown neighborhood of downtown Seattle. Haven't had a lot of activity on it. And one of the thoughts and comments was small place in downtown, not exactly the most desirable of settings in today's housing market. People know that there could be a second lockdown, I think in the fall, maybe winter, if coronavirus comes back and does one of its upward spikes with cases and deaths. We could be in for another lockdown. That could happen. I could see that happening. I don't think we will, but I think people have that in the back of their mind when they're considering their housing decisions, is you want something a little bit bigger than a studio if you're going to have to hunker down again. Or like a lot of the millennials I see, they are working from home. So many of those jobs are literally working from home. I know very few people going to an office or considering going to an office in the near future. People are doing patio projects. People are doing deck projects. Can't tell you how many people I've heard talking about, I'm rebuilding my deck. It's because they're spending a lot of time at home. And if they're going to be home for a while, for the foreseeable future, they're going to make improvements that make their lives better. And buying a smaller unit in a downtown core urban area right now isn't the move. That's what I'm seeing. That's what I'm feeling. Now, I think there will be a boomerang effect. People will come back around when they realize, oh, yeah, this stuff is kind of affordable. It's decent living. I know we had the whole Rona thing, but now we know how to handle COVID-19. We know how to deal with that. Maybe we've got a vaccine. You'll see people come back to downtown core areas because, let's face it, that's where so many businesses are, and that's where all the civic amenities are. That's where you've got all the big stadiums, you've got sporting events, you've got live music. You don't have that in the suburbs. So there's a certain contingent of the population that is always going to go for the downtown core living. That's not really where I've ever been. I've spent a lot of years appraising in those environments, and I'm like, those are really cool views, and it's a really cool unit, and I like the amenities, but I don't want to be on top of my neighbors like you are in a condo or a co-op or an apartment complex. I did my years of apartments when I was much, much, much younger, early 20s. And I've been in a house ever since because that's a priority of mine. Wanted to have my kids in a house. Didn't want to be on top of my neighbors. Maybe someday I'll go to a condo, but I think most people right now are thinking, small condo, not good. Downtown, not good. Look at the number of droves of people in New York City that are getting the heck out of Dodge. And that's because their urban density is so high that I think so many people are like, oh, this is not the environment we want to be in. Let's take off. And so the Hamptons, all of those upstate places where people go for typically their summer vacations, those are becoming destination place. Those are suburbs for our New Yorkers to basically take refuge so they don't have to deal with the Rona during the lockdown. So with a pandemic raging, and it requires you to take a careful look at the environment around you to ensure that whether buying a new home or investing in real property, you make sound decisions. Choose whether this makes sense to your lifestyle. Look at the pros and cons of diving into the housing market. Low rates, more house. That's what's driving all this, right? The low rates. Mortgage rates have been at historic lows for almost 20 years. Gone are the days that boomers remember of 13% interest rates. I remember 13% interest rates, but my family was always in the real estate game, whether as a developer, a builder, appraiser, family and friends who were brokers, that kind of thing. So we were always talking about interest rates. And I remember the really super high interest rates when I was a younger kid. Those were killer. But now you hear the older baby boomer developers talk about how they had workarounds for dealing with high interest rate environments. And now we've had low interest rates for so long that we just kind of take them for granted. But for millennials and Generation Xers, that's me, these 30-year fixed rates in the 3 to 4% range seem the norm. So if you get an interest rate that bumps up to 8%, what's your payment due? It goes through the roof. And at some point in time, we will have to deal with that. And it's going to be a long upward trudge if we see those rates kind of start to inch up, because then you've got all these people in their homes with mortgages. They're not going to want to move, and they're not going to be able to refinance. They're not going to want to refinance because guess what? If they refinance, get a higher interest rate, make more payments, takes them longer to pay off. Just not the road they want to go down. So that's the option of being at really super low rates, is that at some point in time, you're going to have to pay the Pied Piper and rates are going to have to go up. That's just where we're at. You can't keep rates low forever, although some people kind of argue, well, we're in this super cycle and this is where we're at. We're just going to be at for the next 20 years. I don't know. I've seen so many crazy things happen in real estate and business that I don't kind of count anything out, just roll with the punches. Take a look and see what you think the next year or two is going to be. And in my opinion, we've got a low rate environment at least through 2021, probably through middle of 2022. That's what the Fed has committed to. I think that's where we're at. Unless we have some crazy global something happen, war, something major along those lines, another meltdown. I don't know. One of those crazy events that outside of any of our control, and it happens, and you're like, oh, interest rates moved up to 8%. That's not good. Oof. Let's hunker down and stay here. So as rates are dipping now below 3%, many Americans of all ages see an opportunity to either refinance or purchase with very cheap money. This is a powerful incentive as they can buy more of a house than previously anticipated. Further, there might also be a better tax advantage for taking on a bigger mortgage. While the majority of Americans now use the standard deduction, if the mortgage is large enough, the interest payment deduction might be enough to move them into itemizing their deductions. All right, but keep in mind, the reason we're talking about this is that buying a home has become a trend in the pandemic. Are there enough people who are going to have a higher interest payment that it makes sense for them to do the whole deduction thing? I don't know. I think it's a benefit, but the main reason they're moving is because interest rates are really low and it makes sense for them to do so. And if they sell their house now, they can get enough equity out of it because it's a seller's market. They move that into whatever house they want. And that's what's going on. It's basically their lifestyle moves and their investment moves right now. I don't think tax benefits are a big enough incentive to make people move, but I think that is happening. That is out there. And another reason is it's a great way to generate income. Other people are looking to purchase a rental property in order to generate a passive income stream. The time might be right for this as long as there's a new group of renters looking for homes. In affluent areas such as Lake Tahoe and the Hamptons, like we mentioned before, many city dwellers are considering the possibility of renting since their families will want more space and natural environments in the fall for both work and school from home. For potential investors, finding a good rental property has been a priority. For those who can afford to purchase a property rent out, it can be a great income stream. However, it is important to make sure that the rent you will take in will cover all of your costs. This includes not just mortgage and real estate taxes, but insurance and home maintenance as well. If these owners can make their rental cash flow positive, it may be tax neutral due to depreciation. In Seattle and in most other expensive West Coast markets and East Coast markets, rental property doesn't make sense. And that's because even you have to put in such a big down payment to offset the purchase price to get it to the point where your rental income either covers your mortgage payments, your PITI payment, which is principal, interest, taxes, and insurance. You have to bring in such a big down payment to make that either break even or get a slight positive cash flow that you've probably got better places to put your money to get a better return. But that is in the more expensive and affluent areas where you get big appreciation. So you're banking on appreciation in those markets. And if you can break even, that's probably a win long term. Now, where that breaks down is where you don't have an appreciating market like 2008 through 2014. And that's why so many people gave up their homes, because when they went to move, they were upside down. They had negative equity, meaning they owed the bank more than their home was worth. And if they had to make a move, couldn't sell it, couldn't get a short sale done, you give the bank back on foreclosure. And that's why we had millions and millions of short sales, foreclosures, bank-owned properties that are still coming back on the market, bank-owned stuff. Most of that's been liquidated, but every now and then you see something that was tied up in litigation for all these years, and it's finally coming back on. So buying as a rental property, yes. In markets where that makes sense, the low interest rates certainly make sense because you are going to have less debt service, meaning whatever rents you have, they're going to cover more of your mortgage payment, maybe give you a positive cash flow, and then away you go. You hope for that appreciation, and you deal with maintenance as it comes up. But you are potentially buying at the high end. Don't forget that real estate goes in cycles. What goes up typically does come down. So there are, of course, risks to consider in this real estate market. We're seeing significant numbers of people moving out of cities and into the suburbs or smaller urban areas. You know, we keep talking about that. That keeps being the mantra. It keeps being the narrative. And yet the numbers that I'm seeing, the numbers I'm following, don't necessarily say that everybody's running, hightail for the suburbs. You're having people move to the suburbs, but there are also homes being purchased in condominium complexes in downtown core areas. Maybe a little bit faster in the suburbs, but that's always been the case, right? So I think you've just got really low interest rates fueling these markets, and that's where we're at. When bidding on homes in these markets, it's important to maintain objectivity regarding home value. That's a conversation I have with brokers all the time. It's like, all right, if you see posts on Instagram, you'll see people like, there were 18 offers and we were the highest bidder. Congratulations to my clients. And all I can think of is, geez, what did it take to get that property? And was that the best offer out there? Or was it just the highest? And how much over market value did you just launch your clients into to get that property? Now, I know they're focusing on their amazing negotiating skill, but writing a check with somebody else's money, that's where I kind of draw the line when you are way over value. And from the appraisal end, that property still got to appraise if somebody wants to get a mortgage on it, right? So that's where I've come in on so many transactions and gone, hey, wait a minute, am I the only one seeing this? These guys paid 50 grand over list price. It was at market value at list price, and now we're 50 grand over. I don't have the comps to support this. All right, this one isn't going to go well. I'm going to have a lot of people hating me, but that's the whole purpose of an appraisal, is to let the lender know, yeah, does this property have enough equity in it with the buyer's down payment and everything else to have it make sense, so that if you, Mr. Lender, Mrs. Lender, took the property back, you could sell it, cover your costs, get your money out, and be whole as an investor. And a lot of times in these bidding situations, you just basically have to say, yep, I know we're going way over list price, and I know this property is not worth it, but this is what we're going to do. And I'm going to bet on the fact that we are going to have enough appreciation where, 6 months down the road, a year, 2 years down the road, my property is going to be worth it and I'll break even. And so many of those happened at the very end of the Great Recession. All those people buying right at the very tail end, myself included. Did I buy a condo or another home? I bought a condo right at the end, a rental property. And that's a long story, but that one ended, I think, in foreclosure. I think that one got foreclosed. It did get foreclosed. Try not to remember that. That's ugly. And so when you buy at the very peak, like they're saying here, potentially buying at the high, that happens. And when it tanks, it really tanks. And you go sideways. And there's a point at what you get to and you're like, all right, can't sell it, can't short sell it, nobody wants it, give it back to the bank. And then you wait your XYZ number of years, rebuild your credit, and try and move on, limp along down the road. And that's what most of us real estate investors have done since the Great Recession. We're back in the game, but yeah, we took some hits along the way, and you kind of get back up and get going when you can, and you don't worry about it too much. What doesn't kill you makes you stronger, right? Goes for real estate too. So when bidding on homes in these markets, it's important to maintain objectivity regarding home value. Whether it's a personal residence or a rental property, you need to think about time horizon. And a lot of what I talk about is not location, location, location. It's timing, timing, timing. Where are you getting in on the cycle? If it's a property you'll hold for less than 5 years, it might be risky to buy it at any cost. But if this is a forever home or a property that you want to keep for a long time, you can give yourself more leeway on cost. Now, here's where I kind of rely on my real estate experience. I can't tell you how many times I've stood on somebody's front porch saying, hey, I'm Sean Reynolds. I'm from Reynolds & Kline Appraisal. I'm doing the appraisal on your home today for XYZ Mortgage Company. I made the appointment with you. Do you remember that appointment? That's why I'm here. Okay, we get the formalities over and done with, and you start talking about what you're doing. And eventually the people kind of get into why they're selling the home, whatever. Like, this was going to be our dream home. We were going to live here forever. And then I just found out my wife is having an affair and we're getting divorced and we can't afford the home, so we need to move on. This was our forever home. It's where we're going to raise our kids forever and ever. And so many of those conversations over the years I've had where people had really good intentions of a home being their forever home. But guess what? Have a 3-year exit strategy and have a 5-year exit strategy. Because if you don't have those, you are not realistically thinking. And maybe your wife doesn't cheat on you. Maybe your husband doesn't cheat on you. Maybe that doesn't happen. Maybe somebody gets sick. Maybe somebody gets a job transfer. Maybe somebody's parents get sick and they got to go help them, and you need to rent out the house, and you need to keep it for, or do whatever. You need to sell it. You need to sell that bad boy. Have an exit strategy, and if today's game plan doesn't transfer to the near future, then you need to really think about, should you be doing this? And I think if so many people who bought with small down payments and really leveraged their price, just really went overboard to get the house, if fewer people did that, if they had a realistic approach to it, and if brokers had a realistic approach to that as well. Because brokers, you got to admit, they're complicit in this deal too. If you're a broker and you're saying, let's just do this, I want my commission, you're not really doing your clients a favor. And so that's where a lot of times I will talk to my brokers and say, does this make sense to be making an offer up at this price? Because here's where I think it's worth. And if you guys have the cash to do this, and if you know you're going to be blowing off that cash, if you're okay with that and you really want this house, then go for it. 2 thumbs up. But have an objective approach to what you're doing, because you may have to pay for it sooner than later. And that's kind of what we're talking about. But if this is a forever home or a property that you want to keep for a long time, you can give yourself more leeway on cost, meaning you can justify paying way more than the property's worth. That's what we're saying. Further, just because the COVID-19 pandemic has made the cities less attractive doesn't mean they will always be unappealing to buyers. That's what I strongly think is kind of happening right now. In fact, this actually may be the right moment to consider purchasing in an urban area if values drop significantly. We haven't seen values drop significantly here in Seattle, but we've also had just a really strong, like one of the strongest real estate markets in the United States. So I haven't seen values around here drop anywhere. They've all gone up. So we're probably not a good example of that. To some degree, the better investment might be to approach the market from that perspective, since most potential buyers will be thinking just the opposite. They're saying, hey, buy in the urban markets. Buy that condo that you always want. And I've thought about doing that. That would be cool. Have a condo. And then the reason I think about that is when I'm out either mowing the lawn or coordinating some housing project or getting a roof redone, I think, what if I just had a condo and I could pay those homeowners dues and not worry about it? I could just lock up, go to Maui for a couple of weeks, hang out. My house is all taken care of, unless there's some flood on the inside, and then you're hosed anyway. So have that condo in downtown, be able to walk to the grocery store, do all that cool stuff. That always sounds really good, but then I like my privacy too of not having neighbors right in front of me. But the last point here is buy smart. If you're going to be buying a home, buy smart. It's an interesting time in the real estate market with low mortgage rates and the population fleeing to more suburban areas. They're not fleeing. They might be walking, but they're not fleeing. Fleeing to more suburban areas, the landscape is shifting. Remember that being strategic both on how you consider investment in real estate and how you use your real estate over the long terms will have an impact on whether you make the right decisions. So my advice to people right now is if you do need to make a move, take advantage of those low interest rates. If you are iffy on whether the market is maybe a little bit puffed up right now because of these interest rates, and you think there might be a drop in the near future and you don't have to move, then just hang tight for a while. Get through this summer. See where we're at. Get through into Christmas. That's when things always really slow down. And then let's see if next spring we have another good run. I think we will, because we haven't had enough homes in the market to satisfy all the buyer demand. That's why you're almost in September and the market's still going crazy across the United States. That's what's going on. So will this carry into 2021? I think it will. So unless we have interest rates bump up for some outside economic reason, I don't think you're going to see that. I mean, who knows? You could. Something could happen, right, Nikki? You just don't know what could happen. So in summation, if you're a buyer out there and you're dying to get that interest rate, go for it. But make smart decisions. And that might mean not jumping in on your first or second deal if you're in an escalation clause deal where you're competing against a ton of other buyers. I typically don't recommend that, because then you're having to basically get rid of your financing addendum half the time, even though you need financing. Not a good call. You're having to get rid of your building inspection. Not a good call. get your home inspected no matter what, so at least you know what's going on. But you're basically flying blind into a lot of those scenarios just to get the home, because that's what it takes to get it in a super competitive market. So unless you are relocating and you need a home for that very situation, or there's just a super specific home that you're dying to get, don't jump on those scenarios, because those are not decisions that are usually typically well made. Wait for the market to slow down a little bit. And I'm a real estate guy, so the more real estate you buy, the more money I make. That's kind of the whole rotation thing. But I'm also a podcaster, and I have to give reasonable, solid advice. So if I were just to give you my real estate sales guy advice, I would say go buy everything in sight. Yep, and use Summit Properties Northwest. But that's not reality. And anybody watching or listening to this podcast knows that. So make smart decisions when you're out there. Look around and go, is this frothy market, is this going to go on forever? No, it's not. But timing it so that you're not buying at the absolute peak, but know that this market's probably going to keep going up in 2021. I don't think you're going to see a decline. So it's got some legs to it. I think this market's got some legs to it. So know that if you wait until next spring, whatever you're looking at right now, it might be a little bit more. Yep, and I did not turn off my phone. That was my phone going off, so I will get to that in a moment. But the property that you're looking at now will probably be more in spring. Factor that in. Interest rates might be a little bit higher, but make smart decisions is the bottom line. And if you don't have a 3-year exit strategy or a 5-year exit strategy that works, that makes sense to you, really consider what you're doing. Because I don't want you to be that person on the front porch talking to the real estate appraiser going, this was going to be our long-term home, but now we got to sell it, and now we got to take a hit. We're going to lose most of our down payment because we didn't have a reasonable 3 or 5 year strategy plan to get out if we had to. We didn't think about that. This was going to be our forever home, and now it's not. And those are always sad conversations. Those are the ones that I think about, it's like, oh, that one person that I never remember people's names because there's been so many people over the years, but there's a few housewives that I remember talking to like across the kitchen island. And they're like, my husband left me and we don't really have an exit strategy. And this really sucks. And a lot of times they're crying and it's a terrible scenario. And as an appraiser, you have to be totally independent and just say, that is a terrible scenario. Thank you for letting me into your home. Got to go now. On to the next one. Good luck with that divorce. I mean, what else are you going to say? You're not there as a marriage counselor, unfortunately. So business is business, but make smart decisions out there, people. And that's a lot of kind of what I talk about here is not down home advice, but just, hey, here's the nonsense I've seen as an appraiser and as a real estate broker and all this other ridiculous stuff I've done throughout my career and experiences I've had. That's what I'm talking about here on the Seattle Real Estate Podcast. So thank you so much for tuning in. Love to have you subscribe if you find this content helpful or even just informative or maybe even entertaining at times. I know a lot of people are like, yeah, sometimes you don't make sense, but at least it's kind of entertaining. So thanks for tuning in. That's the bottom line. That's from me to you. Thank you so much for tuning in. Again, I'm Sean Reynolds from Summit Properties Northwest, Reynolds & Kline Appraisal. I will catch you on the next one. Bye for now. Have a good one. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.